Stop for a moment, not because the market is crashing today and not because a headline is screaming panic. Stop because the tension you've been feeling lately is real, and it has a cause. This isn't random volatility. This isn't noise. What's unfolding right now is a familiar pattern, one I've watched repeat across decades of markets, currencies, and power shifts, and patterns never announce themselves loudly at first. If you've been watching the dollar closely, if you've noticed gold and silver refusing to act normal, if you've paid attention to how governments speak when confidence thins, then you already sense it. The surface looks calm. Underneath pressure is building. That combination has always mattered more than any headline. Here's the part most people miss. The most dangerous moments don't arrive with chaos. They arrive with reassurance, with experts explaining why everything is contained, with markets drifting sideways while leverage quietly grows. I've seen this before. When cracks are dismissed as temporary, when debt is framed as necessary, when intervention is sold as stability, the surprise only comes to those who ignore early signals. This conversation isn't about predicting tomorrow. It's about confidence today, confidence in money, confidence in leadership, confidence that tomorrow's rules will resemble today's. When that confidence weakens, behavior changes quietly. Institutions hedge before headlines change. Nations diversify before narratives shift. By the time the move is obvious, the positioning is already done. We are in a moment where markets can look calm right before they turn aggressive, where one statement, one miscalculation, one late-night announcement can erase weeks of stability. That isn't fear. That's pattern recognition. In this series, we're going to connect the dots most people ignore, not to create panic, but to explain why gold and silver are acting like signals, why geopolitics suddenly matters again, and why preparation now beats prediction later. If this perspective helps you, don't stay silent. Hit subscribe and comment 1 to let me know you're here and following the thread. Now let's widen the lens, because what you're feeling in markets didn't come out of nowhere. This environment was built step by step. And one of the loudest signals comes not from charts, but from geopolitics, specifically how power talks when it feels cornered. Every cycle has a familiar script. A region becomes unstable. Language gets emotional. The public is told there are only 2 choices: act now or accept disaster. The words sound noble, urgent, moral. But if you've watched enough cycles, you learn to ask a different question. Not what sounds right, but who benefits. Because the pattern is consistent. First, the narrative simplifies reality into heroes and villains. Complexity disappears. History gets compressed into slogans, then questioning the plan is framed as weakness or ignorance, and finally, when consequences arrive, higher energy costs, inflation pressure, financial strain, everyone acts surprised, as if no one could have seen it coming. This isn't cynicism, it's incentives. Power protects itself. Governments protect legitimacy. Institutions protect balance sheets, and markets, always forward-looking, respond before the public conversation catches up. War, or even the threat of it, isn't just political theater, it's a financial event. Risk premiums rise before missiles fly. Capital moves before statements escalate. Energy is the transmission mechanism. It doesn't need to disappear for prices to jump. Insurance costs rise. Shipping routes reroute. Speculation piles in. And once energy moves, it bleeds into food transport, manufacturing, and inflation expectations. That's when central banks get trapped. And trap policy is where confidence starts to crack. Here's the key insight. Markets don't wait for outcomes. They price probabilities. When leaders speak more openly about forced leverage and resources, even without action, volatility becomes a feature. And volatility changes behavior, not overnight, quietly. Hedging replaces optimism. Safety replaces yield. That's why this moment matters, not because everything breaks today, but because the tone has shifted. And tone precedes trend. If you're still following the logic, stay with me. The next chapter connects this directly to currencies and why the dollar's behavior matters more than most people realize. Now we move from geopolitics to the layer most people underestimate until it's too late: currency confidence. Because every major shift in global power eventually shows up in money, and money tells the truth long before speeches do. Currencies don't collapse in a single moment. They erode. Trust weakens quietly. Purchasing power slips. Volatility increases, and the public is told this is temporary, manageable, contained. I've seen this playbook before. When confidence in policy starts to wobble, the first reaction isn't panic. It's denial, wrapped in reassurance. The dollar still dominates global trade, but dominance is not the same as permanence. What matters isn't whether the dollar disappears, but whether the world's willingness to treat it as neutral and stable begins to fade. And that shift doesn't need a dramatic announcement. It happens through behavior, through diversification, through alternatives quietly being built in parallel. Watch what large players do not, what they say. When nations explore new settlement arrangements, when reserves shift incrementally, when trade routes adjust, that's not ideology. That's risk management. No one wants to be dependent on a single system when leverage becomes a political tool. And leverage is being used more openly now than it was in the past. This is where many investors get confused. They expect currency stress to look like chaos. In reality, it often looks like slow discomfort. More intervention, more emergency measures, more justification for deficits. Each step framed as necessary, each step slightly weakening trust. Over time, those steps add up. And here's the uncomfortable part. Once confidence starts to decay, restoring it is far harder than maintaining it. Markets forgive mistakes. They don't forgive patterns. When policy repeatedly chooses short-term stability over long-term credibility, behavior adjusts. Savers look elsewhere. Capital seeks anchors. This is why gold and silver don't move when everything feels good. They move when confidence becomes questionable. Not because people are greedy, but because they're hedging against rule changes. Hard assets don't rely on promises. They don't require belief. They simply exist. The shift we're watching isn't loud yet, but it's real. And once it becomes obvious, it won't be early anymore. In the next chapter, we'll connect this directly to precious metals and explain why their behavior right now is more signal than speculation. This is where gold and silver stop being just trades and start acting like messengers. Because their job isn't to predict headlines, their job is to respond to stress in the system before it becomes obvious. Most people think precious metals rise because of fear. That's a shallow explanation. Fear is emotional and short-lived. What actually drives sustained moves in gold and silver is uncertainty about policy, currency credibility, and future purchasing power. When confidence is solid, metals go quiet. When confidence wobbles, they speak. Gold moves first because it's the ultimate monetary anchor. It's held stored and trusted when institutions want neutrality. Silver follows with more volatility because it lives in two worlds at once. It's money and it's industrial. When both demand streams pull at the same time, price doesn't adjust gently. It jumps. What matters right now isn't just that metals are rising. It's how they're rising, not in a euphoric frenzy, but with persistence. Pullbacks get bought. Corrections stay shallow. That tells you the buyer isn't just retail speculation, it's longer-term positioning. Here's something experience teaches you. When markets stop responding to good news the way they used to, it's a warning. When rate hikes don't strengthen a currency, when reassurance doesn't calm investors, something deeper is changing. Metals respond to that shift because they sit outside the system. They don't care about narratives. This doesn't mean metals move in a straight line. They never do. There are shakeouts, there are pauses. That's how markets transfer ownership from impatient hands to patient ones. The mistake people make is assuming volatility means weakness. In late-cycle environments, volatility often means transition. Another point many miss is timing. Metals often move before the reason becomes clear. By the time the story hits mainstream discussion, the repricing is already underway. That's why dismissing gold and silver as relics right before they surge is a recurring mistake across history. Right now, metals aren't screaming collapse, they're signaling hedging. And hedging increases when trust decreases. In the next chapter, we'll zoom out and talk about why the world itself is becoming less predictable and why unpredictability has become a feature, not a flaw. To understand what's happening now, you have to accept a hard truth. The world is becoming less predictable by design. Uncertainty is no longer an accident, it's a tool. And when unpredictability becomes policy, markets are forced to adapt. In the past, power was exercised behind closed doors. Language was careful. Signals were subtle. Today, leverage is spoken out loud. Territory, resources, and influence are discussed openly, sometimes casually. That shift matters because markets price tone before they price action. When leadership signals that limits are flexible, volatility becomes unavoidable. Unpredictability changes how everyone behaves. Allies hedge. Institutions diversify. Long-term contracts get shorter. Supply chains get redundant. Capital looks for safety over efficiency. None of this happens because of panic. It happens because rational actors plan for surprise. This is why the calm period should concern you more than the chaotic ones. Calm in a late-cycle environment often means complacency. Complacency invites leverage. Leverage creates fragility. And fragile systems don't break slowly. They snap. Another factor most people underestimate is timing. Major moves are often introduced when attention is split and liquidity is thin. Not for drama, but for control. If you want to manage the first reaction, you act when reaction is hardest. Markets have learned this. That's why weekend announcements and off-hour statements matter more than they used to. When unpredictability becomes normal, trust erodes. And when trust erodes, systems compensate with more rules, more oversight, more intervention. Ironically, that often increases instability rather than reducing it. The system gets louder as confidence gets weaker. This environment rewards flexibility, not certainty. It punishes overconfidence, and it quietly favors assets and strategies that don't depend on perfect outcomes. The key takeaway here is simple. The world isn't breaking, it's shifting. And shifts create opportunity for those who recognize them early and risk for those who assume yesterday's rules still apply. Next, we'll connect this unpredictability directly to the economy and explain why fragile growth makes shocks far more dangerous than they appear. Now let's drop beneath the headlines and look at the economic foundation, because this is where shocks stop being abstract. Fragile growth changes everything. Strong economies absorb stress, weak ones amplify it. Right now, growth is uneven. Some sectors look healthy while others are stretched. Consumers are cautious. Businesses delay long-term commitments. Debt levels are high, and margins for error are thin. In this environment, it doesn't take a major crisis to cause disruption. A small trigger can travel far. Policymakers face a narrowing set of choices: support growth or fight inflation, calm markets or defend purchasing power. When conditions are healthy, those goals can coexist. When conditions are fragile, they collide, and every hesitation weakens confidence. The bond market tells this story quietly. Rising yields aren't just numbers, they signal distrust. Higher borrowing costs force governments into trade-offs. Cut spending and slow growth, or borrow more and pressure the currency. Neither option is painless. Emergency support plays a role here. What begins as temporary assistance often becomes structural dependence. Over time, markets stop believing stability can exist without intervention. That belief changes behavior. Here's the key point. Fragile economies magnify shocks. Energy moves hit harder. Supply disruptions last longer. Confidence swings faster. That's why geopolitics, commodities, and currencies are now tightly linked. This doesn't guarantee collapse. It means preparation matters more than optimism. In the next chapter, we'll focus on resilience, what it actually looks like in a high volatility world. When people hear resilience, they often think in extremes. Either nothing is wrong, and preparation is unnecessary, or disaster is imminent and panic is justified. Both miss the point. Real resilience is quiet and practical. It's designed for uncertainty, not drama. In volatile environments, the goal isn't perfect prediction. It's staying functional across many outcomes. That means reducing dependence on single assumptions. It means not assuming liquidity will always appear on demand. And it means understanding that markets behave very differently under stress than they do in calm periods. A common mistake is equating resilience with doing nothing. Calm markets create a false sense of safety, especially late in a cycle. Calm often hides leverage. Leverage hides fragility. When unwinds begin, they rarely announce themselves. Resilience shows up in structure, not excitement. Lowering bad debt matters more than chasing yield. Flexibility matters more than optimization. Liquidity becomes valuable when optionality matters. Diversification also needs to be real. Many portfolios look diversified until stress arrives and everything moves together. True diversification considers how assets behave when confidence weakens, not when conditions are ideal. This is why hard assets re-enter the discussion. not as a collapse trade, but as insurance against uncertainty. Insurance feels unnecessary until it's not available. The core idea is simple. You don't need to predict the future, you need to avoid irreversible mistakes. Next, we'll look at how modern conflict and non-traditional pressure points are reshaping market behavior. Modern conflict no longer looks like the wars most people imagine, and that shift has fundamentally changed how markets react to stress. Power. Today doesn't move only through armies or territory. It moves through systems, payments, supply chains, energy routes, data, and information. Confidence itself has become a strategic pressure point. Markets are built on continuity. When trade settles smoothly, when logistics function, when payments clear without friction, risk stays contained. But when those systems are questioned even briefly, uncertainty rises fast. Destruction is no longer required. Disruption alone is enough to move capital. Sanctions highlight this transformation. They rarely stay confined to their intended targets. Instead, they reshape incentives. New trade routes form. Alternative settlement systems develop, dependencies weaken, and once alternatives exist, leverage is permanently diluted even if nothing appears broken on the surface. Short disruptions now carry outsized impact. A temporary delay in shipping insurance coverage or payment processing can ripple through economies already stretched. These shocks don't follow clean timelines or historical playbooks, which makes them difficult to model and easy to underestimate. This is why volatility shows up far from the original event. Costs rise quietly. Confidence wavers subtly. Behavior adjusts before narratives change. Assets that don't rely on complex systems benefit in this environment. That's why precious metals respond. They exist outside networks, outside permissions, and outside political infrastructure. The core takeaway is simple. Modern conflict spreads risk invisibly, and markets reprice trust long before the public understands why. At this stage of the cycle, markets are driven less by data and more by psychology. Sentiment leverage and narrative alignment now matter more than any single report. Prices move not because facts change overnight, but because positioning does. Sentiment is the first layer. When optimism becomes common sense, risk hides in plain sight. Everyone is leaning the same way. Everyone believes the same explanation. That's when markets become fragile, not because the story is wrong, but because it's crowded. In crowded trades, even small shocks matter. Leverage is the second layer. Leverage magnifies calm and accelerates stress. In late-cycle environments, it builds quietly when volatility feels low. When conditions change, selling isn't optional, it's forced. That's why markets can move faster than logic suggests. Narrative is the third layer. Narratives justify behavior. They explain why prices make sense, why risks are contained, why caution is unnecessary. When a dominant narrative starts to crack, markets don't wait for confirmation. They adjust first and explain later. The danger appears when all three align. Strong optimism, high leverage, a unified story. In that setup, upside becomes limited and downside becomes asymmetric. Markets don't need bad news, they only need an excuse. This is why tone matters more than headlines. Watch how leaders speak. Watch how risks are framed. Watch how quickly language becomes synchronized across media. When confidence sounds absolute, vulnerability is usually close. None of this guarantees an immediate break. Timing is always uncertain. What matters is exposure. Late-cycle markets reward awareness and punish complacency. In the final chapter, we'll bring everything together. Key lessons, strategic thinking, and practical guidance for navigating a world where volatility is no longer the exception. Now let's bring everything together because this is the part that actually matters, not prediction, not drama, strategy. What we've walked through isn't a doomsday script, it's a framework. Geopolitics applying pressure, fragile growth amplifying shocks, currency confidence slowly eroding, narratives masking leverage, and markets responding not to headlines but to incentives. This is how transitions happen. Quietly at first, then all at once. The biggest mistake people make in environments like this is waiting for certainty. Certainty only arrives after opportunity has passed. By the time transitions are obvious, positioning is crowded and choices are limited. Experienced investors don't wait for clarity, they prepare for variability. The lesson is simple. You don't need to be extreme. You don't need to bet everything on one outcome. You need resilience. That means avoiding fragile promises.